Today I'm going to be discussing adjusting entries. Firstly, what are adjusting entries? Adjusting entries are accounting entries that convert a company's accounting records to the accrual basis of accounting. Entries are made in a general journal to record revenues that have been earned but not recorded and expenses that have been incurred but not recorded. Adjusting journal entries arise due to the exchange of cash not always coinciding with the earning of revenue or incurrence of an expense. An example of this is when cash is received before revenue is earned or when cash is paid after an expense is incurred. An important question to ask ourselves is, why are adjusting entries necessary? Adjusting entries are accounting entries which are made at the end of the accounting cycle, and they consist of deferred revenue, accrued revenue, deferred expense, and accrued expense. Yeah? Firstly, let's talk about deferred revenue. Companies sometimes may receive cash before they earn the revenue. An example of this would be a company selling a 12-month subscription of a fruit basket delivery, in which they receive a total of $120. This is what the transaction will look like. $120 for cash and $120 for unearned revenue. Next is accrued revenue. This can be exemplified through a company providing a service and then collecting the cash. The word accrue is defined as an increase. An example of this can be a company completing a service for a customer for $2,000 on the 10th of September, then bills the customer on the 25th of September, and then receives the payment on the 10th of October. This can be depicted like this if we assume the company will record the revenue at the end of the month, with $2,000 in the accounts receivable and service revenue at $2,000. Next is deferred expense. Sometimes a company may pay cash before they incur an expense. A prime example is insurance. To illustrate this example, we can suggest a company on the 1st of August purchases a 12-month insurance policy for $5,000. This will increase prepaid insurance while decreasing the cash account. Lastly, accrued expenses is when companies incur expenses and pay for them later. A common example is employee salaries. This is another name for a liability. An example of this can be a company's daily payroll being $2,000. If they prepare their financial statements on the 30th of January, companies must record $10,000 worth of expenses on this day, leading to an increase in liabilities and decrease in equity.